Hi, this is Randy Finney with Right Side of the Chart, and this is a closing market wrap for Tuesday, March 17th, 2020. We'll start out here with the broad markets, look at SPY, QQQ, quick look at the futures, and I want to point out the small caps. I haven't talked on small caps in a while, and I think there could be an opportunity there. So we'll start there, then we'll run on and hit on the active trade ideas right now, such as gold, LQD, the investment grade corporate bond ETF, and we'll look at the other type of bonds out there, treasuries and junk bonds real quick as well. All right, so starting out with QQQ, so far, knock on wood, well, we can say definitively so far, proved to be a good move, closing that trade yesterday. Nice rally, about almost 7.6% gain in QQQ today, closed up at 182.14, so we were able to, sidestep a give back in gains. And the $1 million question is, will this prove to be just another one-day wonder? Obviously, I don't see anything getting any better fundamentally, but I made the technical case for a bounce yesterday, especially late in that final video at the end of the day covering the S&P 500 sectors, and kind of maintain what I said then yesterday. There's still the possibility of one more thrust down to hit some of those sectors. Haven't hit support yet, some have, but we also have some pretty decent support forming in NQ. So I'm open to anything here. It's not all clear, get back into longs right now. Like I said, aggressive traders can certainly, and flexible traders can certainly try to game these counter trend rallies. You can make more in a single day in something like QQQ than you can make in oftentimes in a good year. We're just coming off the biggest bull market in history. If you've traded for many decades, if you've been around for a while, you know that that's talking closer to the average returns on the stock market, average annual returns there. So again, it's active trading during a correction or a bear market. It's like swing trading or even trend trading in very fast forward motion. With that fast forward button hit to max speed, you got to get in, get out. So let's talk about where we might go. So again, part of that again, the basis for getting out of there and for me taking home some longs last night, as I mentioned, was the fact that 169 level is pretty good support on QQQ there. So that was part of it, and everything else I made yesterday, the case I made for that. Then on the 60-minute chart, let's turn on this board here. Was this the one? No, it's not. Oh no, it was a 30-minute board. That's right. I usually go to the 60-minute. This is the chart that I shared this morning in pre-market. So we went on since that initial chart that was posted. We were below R1. That's resistance, first resistance level. We took it out. Came very close to the T1 on QQQ, but the reason we reversed and hence also the reason why I always post charts of the futures, and I encourage those that don't trade futures, if you're really serious about trading QQQ and SPY, track them. Most brokers, a lot of brokers will give you free futures charts. I know Ameritrade does, even if you don't actively trade futures with them. And investing.com, that's another source for free real-time charts on stock futures. But I'm trying to pull up here. There it is right here. All right, so this is the NQ 60-minute chart that I posted this morning as well, and here, let me pull that up. Okay, that would be in this morning's post right here, QQQ, SPY, and NQ price targets. So we'll zoom in a little bit. Remember, on the images on the site, you can click and pan and zoom once you've expanded the chart to get further detail. So that's where we were. So I just going up here. Arrow breaks show where a reaction is likely, or a significant resistance level or target or anything else. Yeah, I put R1 because it just wasn't enough meat on the bone. You could say that was T1 if you wanted a quick profit, but I was looking more for a break of that to open a door up to that T1 level, and again, probably get a reaction there, whether we hit that tomorrow or not. Technically speaking, we came close enough, and maybe that's it. Remember, this fundamental landscape has not improved. I'm looking just, and I think part of what today was bargain hunter stepping in at support where they showed with an extremely oversold market, mixed in with some short covering. You're going to get that after the big move that we had yesterday, and of course leading into that as well. And so there's the potential targets, and what had happened at the same time, NQ was down here in the NASDAQ 100 futures. We were at 71.50, There's R1. You can see nice, clear, some pretty clear definition there, an important level. And then the T1 right up there about 75.57. So that was earlier today. That was before the market opened, and you can see we went on from there to pop it, took it out, and then boom, just a quick run right up there. You can see right up to that first target, provide an opportunity to book some quick profits. And then, as I said, I believe in the update earlier today, support once broken, 72.93 was support. I'm sorry, resistance once broken, access support, and that's what happened here. And remember, we're in volatile market. You're going to chop through. It's not unusual to see a quick spike through there, but each of the bodies of these candles remained above there. Those are 60-minute candles, and so that's it. We're kind of now this is the story for tomorrow, and even maybe tonight. We're kind of pinched now, sandwiched between support and resistance. We have support down below, so obviously it would, for the bullish or near-term bullish case, it would help to see that support hold. If we break that support, that could certainly open the door for a move down here. But as I mentioned, we have this, short-term, really triple bottom support right here around. That is at give or take about 69.31, and that's a pretty significant level. So if that breaks, that will most likely trigger a wave of selling, unless it's anything other than, I'll tell you what's not unusual in these type of markets when there's well-watched levels. Everybody's watching them. The ones with the muscle in the market now are the algos, algorithmic trading programs. Didn't know traders see these levels, and so on those big firms, they have a lot of capital, enough to move the market, especially in the futures overnight if they are in there playing at that time of night, and I'm sure some of them are. But what I was getting at is sometimes they'll see a well-watched level. No, there's a cluster of stops. Take it out. You get a quick swoon down as all the stops are hit. More shorts pile in, and then they reverse it. So now it can also go the other way. It's bearish until unless it reverses. So how to trade that? Well, a couple reasons, a couple ways. You could short the break and then you have a stop a little bit above. But if you're looking to go long because you think the markets are the selling's a little overdone here, very aggressive, but you can buy into that swoon down, the initial surge. Look for a near-term selling climax like this, a big red candle like that on high volume. It's a selling climax there, near-term selling climax, that one, and you kind of get a little support. Or the safe bet is wait for recovery back above that level, because if you drop below there and then we regain it, then it proves to be a bear trap, aka false breakdown. Bears pile in and then they get roasted. But as of now, we're not even there. So those are levels to watch. That R1 resistance, now support, which, I'll change it now to S1. Edit commentary, make that S1 because it's no longer resistance. Or we'll do this, R1, S1. That's it. For above it, it is support. For below it, it's resistance. And again, first target, which was already hit, that's the red line above it's a Fibonacci retracement level. And so I'm still favoring in the overnight session. I think this trend line, I think it's time to get checked. We haven't checked that trend line in a bit. What I mean by that is a tag of the trend line. It comes all the way off this level here, and every so often when you're in a downtrend or an uptrend with an uptrend line, same thing, you pull back and you check it. We don't have to check it right now. There's no guarantee that we need to, but if we do, I think it's a well enough watched level that would probably get a reaction. So if you are trading overnight, the futures or into tomorrow, and you see a level that level get hit, you can do one of two things. You could book profits there, or tighten up stops in anticipation that we might break out and continue to run up there. Or you can also or do a combination of the above. If you took profits and then recycle in on a pullback and then go long again on a breakout if it happens. Otherwise, remember, we are in a vicious bear market, so don't get too complacent. I'm showing you levels to target if we do bounce. I'm showing you, as I told you before the close, I'm still leaning towards more upside there. We didn't hit it in QQQ today or NQ, that trend line, but I think there's a decent chance tomorrow we can get that. I'm looking for maybe the first day of 2 green days in a while too, at least intraday. Like I said, that's the thing, and we hit that in the morning. Let's just say the futures do hold up and don't tank overnight, which is of course a possibility. We hit that level tomorrow, pop it in the open, maybe even this T2 level here, any of these targets, that may be it, and I think it probably would be it for the move. That's my maximum upside target, so don't be confused when you see T1, 2, 3, T3 and say, oh, well, Randy's certain that we're going up there. I'm not certain, but I'm open to that possibility. And I think if we got there, there would be a lot of sellers stepping in if we happen to get that far. Try to quantify it for you. That's still above, about 8% above where we're at right now, a little bit more than 8%. The trend line is about 3.7%, depending on where it comes in at. Of course, trend lines are dynamic, meaning every day the price changes, it comes in at a lower and lower level. So it's hard to say exactly what the gain would be if and when we hit it. All depends on how soon we do. Okay, so there's QQQ again. Targets trend line right there, and if the trend line gets popped, that was a great level to reload on shorts the other day there. That rip into that 192.72 level, was already very well defined support, the top of a very significant gap, and the fact that you had another reaction there only further validates it as a very important resistance level. And in my opinion, it's almost too obvious. I don't, if we happen to get there, probably see the sellers step in early. Or the other opposite happens. You think this, they blow right through it and clear the stops and then reverse. But again, that would be, right now, something's going to have to change in the fundamental landscape of the economy, I think, to go much above that level. So if, again, we happen to get there, that may be a very objective place to reload some shorts and get out of some longs if you're trailing stops up right now. All right, let's see. SPY, did I cover SPY already? Yeah, I think I did. If no, well, not in this video, but here it is, that trend line right there, 260.90 resistance. The SPY's been lagging a little bit today. If it can pop it, there's also that big gap right there, comes in to the top of the gap around 273.57, just above, just slightly above that high from Friday right there. And then the one that stands out, this is one I wanted to update with you guys. The small caps have just been taken to the woodshed in recent months, and let's take a look here. I didn't even mark this chart up. No, I didn't. All right, let me give you some lines here. Let me get rid of all these. Get rid of all these trend lines. Clean this board up a little bit and draw some for you. We're on a 30-minute chart. I might have marked it up on the 60. Let's see if I did that. Nope. Sure didn't. All right, we'll just go back to that 30-minute chart. That's fine right now, but the market's moving so much, I'm comfortable using the 30-minute charts instead of the 60, or use them both, of course. All right, there's a comparable downtrend line right there, so that's the first level to watch. And you have just like you did in QQQ and SPY. I showed you the, we had bullish divergences on this time frame here, this 30-minute chart, both on the RSI and the PPO there. So you have the divergent low, and there's some levels to watch above. And again, I'll show you the daily chart in a second. The small caps have just been clobbered lately. So these are some potential targets right there. Those trying to put the lines at the most significant levels. So that's it. You have an intersecting level about 111 resistance, price resistance. It's the bottom of this potential basing pattern here. So it's certainly a consolidation range lately, and you had a consolidation range here that defined the top of that level, and you have a downtrend. So all those come together, or those levels come together, and that could create a nice a pop if that's taken out. So that's a level to watch, whether it happens tomorrow, whether we drop and come back up to it again. But if it happens tomorrow, it's nice because it comes in with both downtrend line and price resistance. I like to see the more levels that break out at once, the better. My thought process is, some traders might be looking at this trend line, others might be, more focused on horizontal price support and resistance, so you get the best of both worlds if they both go long there. But the most important thing I can say here, and I often say this, resistance is resistance until unless taken out. So that we're in a downtrend. Every other time we've come to this trend line, you can see what's happened. We've kept going lower, so we need to respect that and just wait. So it's a potential setup for tomorrow is what that is. And to take a look at the futures, the RTY, there's actually there's a couple ways to go. If you like leverage and you're in and out of this market quick, UWM is a 2-time leverage Russell 2000 ETF, so you're increasing your leverage there by a factor of 2 over IWM, and then you have TNA, which is 3 times if you want to really juice it up. And if you want to juice it up more than that, then you trade futures. And here we have RTY, these are the Russell 2000 E-mini contracts. You can see same thing, divergence right here, positive divergence there at the lows. I could add a few levels for you here, which I probably should do. And another option here, if right now with this volatile market, you want to keep your position sizes smaller, and the Russell contract's a little too heavy for you. M2K, M is in mini, 2, the number 2, and then K. Those are your that's your symbol for the mini Russell 2000 futures. And the nice thing about all the mini contracts, they have them for the NQs. You go MNQ, just put an M in front of there, or ES, you do MES, and they have the same exact levels of those NQ and ES and RTY charts that I'm cover here all the time, except a smaller leverage factor. So you can trade futures if those bigger E-mini contracts are a little too much for you as far as position size or exposure. So that's it. So there's your downtrend line right there, and you can see there's about 1100. It's comparable to that. What was I think 111 level I just said on IWM? It's about 1104. So if IWM or Russell 2000 futures can pop it, they do have downtrend line resistance to contend with, and actually a little bit of minor resistance, price resistance there as well. You have the top of that candle and a couple there. And so then it should be, quote unquote, should be smooth sailing if it can pop above that 1137-ish level and the downtrend line. You can see that would be your first target and a potential second target. Let's just show you how the small caps have been faring lately. When you take a look out on the daily chart, in complete free fall. This was all these lines here. Let me just make it simple for you. This was just and I've covered this in the past quite a bit, but I kind of backed off the small caps for a while. This was a massive, almost year long. This is 2019, the beginning of 2019. So heading into the end of 2018, we were consolidating in that range. Then we had the meltdown, into the December 28 lows. 2018 lows, with a V recovery right back there, and the small caps went right back into their trading range. Well, finally they broke out, so bulls cheer that as bullish. Face value will break out above a multi-year trading range but it failed right here. And as I say, fewer things in trading and investment are more bearish than a failed breakout. And again, it's not as if it wasn't predicted in the charts or indicated with divergences heading into those highs right there. Before the small caps peaked. But once they failed, and this is similar, I'm going to get to LQD in a second, what I'm looking at here, you tend to come down when a breakout fails, you're going to go back down usually to the bottom of the price channel, and that's what it did. Look at that. Came all the way down, bounced there, so there's a tradable bounce to be made all the way back to at least the midpoint of the channel. But then when the bottom of that channel broke, that was big support, multi-year support, and the bottom just fell out of the small caps. I mean, these suckers are down in just a matter of a few weeks here, 39, almost 40%. That's an index of 2,000 companies with small caps, small cap companies. So they've certainly been beaten down. Might be a valuation case to be made for some of these companies. And looking at this long-term weekly chart, like everything, I think they're in the early stages of a bear market with much more downside to come. There's no mistaking that when I look at the charts. It's just a matter of, where's the next bear market rally come from? 40% drop in short order. These guys can kick back 10, 15, 20%, not even blink. That wouldn't even be a, that wouldn't even be a 38.2% retracement or anything right there. It would be a small retracement, and that'd be a 20% pop. So they're on my radar, and I think there's more bang for your buck. Here it is. There's a chart I had on the 60-minute chart. There's a downtrend line right there. Same levels. That's the one I was covering here. I think I had it on a 30-minute chart, but there it is. There's your divergence on the 60-minute chart as well. Is the 30 that I showed you earlier. 111's that level, and then that one rounded off. It's 1 penny shy. Some nice round numbers for IWM traders. There you go. 111, break of that level. Could spark a rally up to 120, which is about an 8% rally. I would expect a reaction there. If it happens to pop it, there's a big gap above that might want to be backfilled. But let's just focus on that for right now. And of course, that's if the market can mount anything more than a one-day rally, which so far hasn't been the case, but I'm leaning towards that. I think I made that clear today before the close. All right. Let's shift over to corporate bonds because this one, like I said, I left it on intentionally. After closing out the QQQ short, even going long, expecting to bounce there, but I still like this one. Why? Now you might normally say, okay, why did corporate bonds drop today? Why do we have a 4% drop? With the stock market rallying here, isn't that whole thing about the investment grade, the triple B bonds rating? When the stock market rallies, there's a little less fear. It's showing people are a little more optimistic about the economy, at least for that day. When you get a 6+% rally in the stock market. Well, there's two factors, and that's what I had said in recent videos. I think we have a win-win situation here with this LQD short, because if the stock market tanks, or if and when it takes another big leg down, that's only going to be bearish for the economy. If the stock market's falling, that is, it's people voting with their feet, if you will, exiting stocks because they don't, like the future prospects. And so therefore, it only makes sense that you're going to see more downgrades, especially on those triple B, that large issuance of triple B debt, which, as I said earlier, the problem with LQD or any, it's not just LQD, this is just the one we're picking on because we can't, short mutual funds. There's hundreds of mutual funds out there, if not thousands, that hold investment grade bonds, and so they're going to have the same issue where those bonds get downgraded and they fall. So okay, so why did it drop today? Well, the win-win part is when the stock market rallies, two things happen. Typically, interest rates rise that day because bonds fall. Bonds are a flight to safety bid, and when the stock market rallies, it tends to mean economic growth expectations are a little bit better, so therefore interest rates rise. And remember, bonds and interest rates have an inverse relationship. When the interest rates on an investment grade bond, like a treasury bonds or these, when rates go up, the value goes down. So pretty much that's it. So if the market rallies, continues to rally, you'll probably see more of that flight to safety bid unwind. And when I say flight to safety bid, I'm talking about money that was, heading into, normally heads into investment grade bonds such as treasury bonds and high quality corporate bonds. So it worked out well today. We're not there yet. We're only about halfway. We shorted it somewhere about right here. Remember, we first shorted it here, milked it all the way down to right here, captured almost all of that move, and we have a two-time position, 200% position weighting, or a double size position, because these are corporate bonds, and so that was good for about a 22 or something percent gain. Then we shorted somewhere in here a few days ago, late last week, on this kickback rally to that former first target, and so we're, like I said, we're close. We're about halfway down to the target there, and that's probably about a 10%, 9-10% adjusted gain if you factor in the double position size so far. So I just want to say it looks good. That's all. And what I was talking about earlier. Remember that multi-year trading range I showed you on small caps? Well, this is similar setup here. So I want to just say the potential is there for a lot more. We have a almost identical technical posture. You had a breakout, and this trading range, by the way, is much larger. And look at the time, and this starts back in 2010. This trading range, very, very well defined. Breakout and corporate bonds, and a massive, very impulsive, clear failure. And so far, we're about 2/3 of the way down to the bottom zone. I see very little stopping this thing. I mean, we could have kickback rallies along the way, but I feel pretty confident it's coming down here to the bottom of the zone around 111, and that's where our first target's coming in right now. I may extend that and allow it to be a potential runner trade, but I do expect, I think we'll most likely get, if and when that's hit, especially if it's hit soon, just like IWM gave us back, a few months ago, an initial reaction. So what we'll probably just close that trade out, and then maybe look to recycle back in short later on a bounce back to resistance, or a break down below the bottom of the trading range, because that would be very bearish. And that's all going forward. We'll see what the economy does, how the coronavirus situation evolves, how the fundamentals in the economy evolve, and the technicals in the stock market as well. TLT, I've talked on this quite a bit. We don't have an active trade, but I mentioned how I thought the risk reward was just very, very bad, very poor recently. As I said, very down, hardly any upside potential in the prices of Treasury, 30-year Treasury bonds. That is, at least, with the downside risk much bigger. And look, the Treasuries fell another 6.7% today. I'll tell you the truth, this is not good for the market. I mean, part of that is, yes, the market rallied, so there you're seeing this risk on trade unwinding right now, but. What scares me is, all those underfunded pension funds. They also had a very heavy exposure in both stocks and bonds. They should have been, in my opinion, a lot more in cash and safer investments. 11, almost 11 years into the longest expansion in history. But whatever, though. But where I'm going with that is, this isn't good. That's a big, big drop on treasuries, and they've been falling lately, and it's just going to kill these underfunded pension funds. It could blow up a mutual fund or an over-leveraged hedge fund, I should say. Most mutual funds aren't that heavily leveraged. Banks, other institutions, just not a good thing to see treasuries dropping like this. I'm staying clear of that trade now. Where they catch support, maybe here's a trend line here. I'll extend that. I'll show you some levels. There's some support where we're at right now. We have uptrend line support that may come in there. So if they continue to fall, I'd say there's just a little bit of downside in the near term. I would think to about 148.83, and what that would do too. This would mesh with my scenario for a little more rallying in the stock market this week, tomorrow, maybe into Wednesday. Nope, that would be maybe into Thursday. Tomorrow's Wednesday. A little more downside there in treasuries. Catch this trend line. You could maybe game it long for a bounce. I'll have to look at ZB. I haven't done that recently. I'll clean up my chart of ZB. There's a trend line right there. That's probably the same one. Just have to update this chart. And there's also price support right here. So I know I'm all over the place. CB is the 30-year Treasury bond futures. There's some support there about 169.022. You also have support a little bit above where we fell today, about 170, 158, and then really nice support down here. So one to watch. I don't see a very clear high probability setup, but I do think the downside right now in the near term is limited, and I do think it would coincide, like I said, with a little more downside in treasuries maybe tomorrow or the next day, coinciding with a more upside in the stock market. And then when the stock market hits those resistance levels, that I'll be reversing back to short on or around there. At the same time, that's when hopefully, if everything goes right, the market reverses, and then people start buying treasuries again because the market's going down again. Okay, and a quick update on gold. So far, so good. We hit took out both T1 and T2 today. Hit that for a quick gain. I think what was it, 5.5% or whatever. So nice reversal. Most importantly, it did hold that 136.37 support so far. Could be it for the end of the run, at least near term. That's a pretty significant support level right there. I didn't expect it to go straight up to T3, but I'm going to give this one some room. So we're in it at a good price. If it falls back down again, then this is still support, and we'll leave the stop as is right now at 133.49. Just want to say that that provided a quick bounce up. It was up quite a bit earlier today, and provided an opportunity to either take some partial full profits, trade it as you want, or if you're a longer term trader, you may have gotten in at the right time yesterday when we went long, added that as an official long trade. So all right, the other one I wanted to mention was crude oil. That's it, and then we'll wrap it up. Crude oil. And I'll say this. I talked about, I'm going to loop back around, junk bonds. Again, I could have picked on junk bonds with the, that's the easy play. That's where I think a lot of, I've been doing this many years, and junk bonds trade more in line with the stock market than they do with interest rates. So TLT, LQD, typically at most points in history are much more, almost completely subject to interest rates as far as their prices go, whereas junk bonds trade much more in line with the stock market because it's not so much they're paying a very high rate of interest as it is, so they're not so rate sensitive to changes in rates, number one, but more importantly, these are below investment grade rated bonds, meaning they're paying interest, they're paying you interest now, and they're promising to pay you your principal, but a lot of them aren't going to, especially when the economy turns and goes into recession, because what happens is default rates spike, so you stop those bonds, a good percentage of those companies stop paying interest, and they may pay some, all, or none of the principal back if the company goes belly up. And so like I said recently, that train had left the station, and and there wasn't a lot of meat on the bone. There's still not right now. See, they were up today, 0.72. Why? Well, because the stock market rallied, yet treasuries got killed, and corporate investment grade corporates got killed. So we're in the right trade, and there might be a time where I might revisit and look at junk bonds for a short trade, but not now. I just want to let you know that I watch this stuff, and if I don't bring it up all the time, sometimes something falls off my radar, so feel free to bump me on something if I haven't mentioned it, but I just want to let you know I'm staying away from that trade for the time being. USO, last night I posted crude is starting to look sweet, with a little pun on light sweet crude oil. All right, there's, give you, yeah, there it is. A nice little bullish falling wedge. That's the same one I posted last night, but crude was rejected. USO was rejected on. There's the divergence lines right there. Nice, strong, positive divergence. I would put pretty darn good odds that we're going to see a big up day in crude tomorrow if the stock market can rally again. I'm surprised it went down today with the rally in the market. It's coming up. I believe we have some support here, long-term support, maybe not so much on USO, on crude futures when I go back far enough. It's kind of in a very, it's in an ugly technical posture, but again, extremely oversold. Something that here's an asset that up until recent weeks had an extremely tight correlation with the stock market. I showed that before. And because that's usually a play on economic growth. It's been overwhelmed with some supply demand dynamics. The Saudis just having that outright oil trying to crush the Soviet Union, Russia, excuse me, I just dated myself. And saying, look, we're the lowest cost producer, so we're going to flood the market with oil. We're going to pump out all we want, and we can manage it. But look, that's going to come to an end soon. The pendulum's swinging pretty far, so I'm looking for a potentially explosive short covering rally in oil. Probably you can see there. If it breaks out of that wedge, and if it can do so tomorrow, I don't see anything stopping it until it goes up at least 12.74%. So I may even add that as an official trade. Potential, if that target's hit, that's about almost 20% right there. And finally, if it goes all the way up to that 731 level, that's about a 27% gain. So that is one of my favorite setups right now. And I'm going to give you CL crude futures, and we'll wrap this up. This is the same chart I showed you last night, but I'm going to have to drag the divergence line down. We're below this trend line. I cannot recall if I had that trend line on there. There's another one I had before. We're kind of back testing. So it's kind of like a channel here. It's not a perfectly parallel channel, but those are the three lines I'm looking at. Trend line down here on crude futures. This is more of just really your divergence line, showing you the positive divergence. It's been taken out now on the RS. Well, no, maybe not. Positive divergence, all you have to have is prices making an equal low. Prices making a lower low, and the indicators making an equal or higher low. This is called flat line divergence. You can see right there. I put the slope on that line at 0, and it still has divergence there because that indicator has not made a lower low yet, below that previous low. So the ideal scenario, if crude's going to do it, it's going to go soon. There's that reaction. That wasn't a long-term support level. It was this level I was looking at. So that's that major drop back here. That was on that Saudi the news when the Saudis came out and said they're just going to pump away to their heart's content, and that is a major reaction low. So I can make a case. You can step in now with stop somewhat below that, or wait for breakout of this trend line here. You can see this is still the first target, potential second target zone. But you know what I need to do now? That was a resistance zone last night. We're going to make that the first target zone, because that is now enough meat on the bone to take profits there if it gets there. And so we'll call that T1 zone. We really need to make that a zone when I have two resistance levels in close proximity. That's what I call it, a zone, because it's hard to say which one's going to produce the reaction. Sometimes you go right in the middle between the two, and then T3 zone. All right, guys, we're going to wrap it up here. I'll probably post these charts again, static form. I did post this one last night, but that chart's a little stale now, so this one's up to date in the video, and if anything happens overnight, I'll post it again, or if I see any other levels. We'll wrap it up here. This has been Randy Finney with Right Side of the Chart. Hope you enjoyed it.